What if I told you $10,000 could start paying you a monthly salary? Not in 30 years, but next quarter. While your friends stare at their savings account wondering why nothing's changed, you could be getting dividend payments like clockwork. $12.50 here, $33 there, even $450 if you know where to look. And the best part? Those payments grow automatically, year after year. Alright, here's exactly what we're covering in the next few minutes. First, I'll break down 5 ways your $10,000 or more can generate dividend income. Then, I'll show you the specific funds behind each strategy. Next, I'll reveal the biggest mistake young investors make when chasing dividends, and why it could cost you hundreds of thousands. Finally, 3 bonus strategies most people miss, including one that could turn your $10,000 into serious money. Before we dive into the numbers, let me ask you something. How does it feel knowing your money is doing nothing right now? While you work 40+ hours a week, your savings earn enough for maybe a candy bar each month. Meanwhile, people your age have figured out how to make their money work just as hard as they do. That $10,000 could be generating income while you sleep, work, or have a vacation, even if in small amounts at first. So let's stop talking about what your money could be doing and start showing you exactly how to make it happen. Strategy number 1, the S&P 500 Foundation. Let's start with the most popular choice, the S&P 500 Index Fund. This is what Warren Buffett calls the best investment for most people, and there's a good reason why. When you buy an S&P 500 fund, you're essentially buying tiny pieces of America's 500 biggest companies. We're talking Apple, Microsoft, and Amazon, the companies that dominate our economy. The dividend yield on the S&P 500 cites around 1.2%, which means your $10,000 generates about $120 per year. That breaks down to roughly $12 per month. Not exactly life-changing money. But here's why this matters. It's the safest, most diversified way to start earning dividends. Plus, these companies have a long history of growing their dividends over time. The beauty of the S&P 500 is simplicity. You don't need to research individual companies or worry about picking the wrong sector. You're betting on America's economy, and historically, that's been a pretty safe bet. Strategy number 2, the Dow Jones approach. Moving up slightly, we have the Dow Jones Industrial Average. This index focuses on just 30 of America's most established companies. Think Coca-Cola, IBM, and McDonald's. These are the blue-chip giants that have been around for decades and know how to pay consistent dividends. The Dow typically yields around 1.6%, which gives you about $160 per year from your $10,000. That's roughly $13 per month. Not a huge jump from the S&P 500, but still better. What makes the Dow interesting is its focus on mature, profitable companies that prioritize returning cash to shareholders. These aren't the flashy growth stocks that make headlines. They're the boring companies that make money. Strategy number 3, high dividend-focused funds. Now we're getting into more interesting territory. High dividend funds take a different approach. Instead of buying every company in an index, they cherry-pick the ones paying the biggest dividends. Take the Invesco S&P 500 High Dividend Low Volatility ETF, for example. This fund looks at the S&P 500 and only buys the companies with the highest dividend yields and lowest price volatility. The result? A dividend yield around 4%. Your $10,000 in this fund generates approximately $400 per year, or about $33 per month. Now we're talking about real money, enough to cover a streaming service, a gym membership, or help with groceries. The trade-off? These companies typically grow more slowly than the overall market because they're paying out more of their profits as dividends instead of reinvesting for growth. Strategy number 4, sector-specific plays. Here's where things get really interesting, focusing on specific sectors that naturally pay higher dividends. Energy companies, for instance, often yield 3% or more because investors demand higher income to compensate for the sector's volatility. The Vanguard Energy ETF yields over 3%, which means your $10,000 generates about $300 annually, or $25 per month. Real estate investment trusts, or REITs, are even better. By law, REITs must pay out at least 90% of their profits as dividends. The Vanguard Real Estate ETF also yields around 3%, giving you that same $25 monthly income. The key with sector investing is understanding the risks. Energy can be volatile due to oil price swings and environmental concerns. Real estate can be sensitive to interest rate changes. But for investors willing to do their homework, these sectors can provide excellent dividend income. Strategy number 5, individual dividend stocks. Finally, we have the most aggressive approach, picking individual dividend-paying stocks. This requires more research and carries more risk, but it also offers the highest potential income. Consider a dividend aristocrat like AbbVie, which currently yields 4.5%. Your $10,000 investment would generate $450 annually, or about $37 per month. Dividend aristocrats are companies that have increased their dividends for at least 25 consecutive years. They're the elite dividend payers with proven track records of taking care of shareholders. The advantage of individual stocks is the potential for both high dividends and significant capital appreciation. If you pick the right company, you could see your dividend payments grow substantially over time, while your initial investment increases in value. But remember, with individual stocks, you're putting all your eggs in one basket. If that company hits hard times, both your dividend income and your principal could be at risk. The biggest mistake young investors make. Now, here's something crucial that most people your age get completely wrong. If you're in your 20s or 30s, chasing high dividends might actually be costing you massive amounts of money. Here's why. Dividend-paying stocks typically grow slower than growth stocks. When you're young, you have something more valuable than any dividend: time. That time allows compound growth to work its magic. Let me show you what I mean with real numbers. If you invest $10,000 at age 25 and earn 8% annually, you'll have $217,000 by age 65. But if you earn 10% annually instead, you'll have $452,000. That's more than double the money from just a 2% difference in returns. Most high-dividend stocks can't match the growth potential of companies like Apple, Amazon, or Google in their early days. These growth companies reinvest their profits to expand rapidly instead of paying dividends. So while collecting $37 per month might feel good now, you could be sacrificing hundreds of thousands of dollars in future wealth. If you've made it this far, you're serious about making smart money decisions. And because you stuck around, I want to share 3 bonus strategies that could multiply your dividend income over time. Bonus tip number 1, the dividend growth sweet spot. Instead of chasing the highest yield, look for companies with modest yields but strong dividend growth rates. A company paying 2% today but growing its dividend by 10% annually will eventually outpay a company yielding 4% with no growth. This strategy gives you the best of both worlds: growing income and capital appreciation. Bonus tip number 2, the DRIP advantage. Set up Dividend Reinvestment Plans, or DRIPs, for all your dividend investments. Instead of receiving cash payments, your dividends automatically buy more shares. This creates a compounding effect where you earn dividends on your dividends. Over time, this can significantly boost your total returns without any extra effort from you. Bonus tip number 3, the tax advantage turbo boost. If you're investing through a Roth IRA, your dividend income grows completely tax-free. This means every dollar of dividend income keeps working for you instead of going to Uncle Sam. Plus, qualified dividends in taxable accounts are taxed at lower capital gains rates, not ordinary income rates. Understanding these tax advantages can add thousands to your long-term wealth. You now have the complete roadmap for generating dividend income from $10,000. If this helped you understand dividend investing, smash that like button. and subscribe for more wealth building without financial advisor fees. Don't just watch and do nothing. Pick one strategy that fits your risk tolerance and take action this week. Your future self will thank you for every month you start early. The best time to plant a tree was 20 years ago. The second best time is today. Thanks for watching, and I'll see you in the next video. Remember, simplify money. Muchafy wealth. One smart decision at a time.